Thank you also for this invitation to the FMM as a whole. I'm really happy to be here to talk about Brazil because, as many Brazilians, I really like to talk about Brazil. So the title of the presentation is Inflation and Income Distribution in Brazil from a Kaleckian Perspective. And to start with, I would like to talk a little bit about some stylized facts. So if I were to ask you what do you, a fact that you remember about Brazil, I think many of you would say that Brazil is a country with very high income inequality. So here's the data from the last 20 years, and indeed Brazil stands out as one of the countries with the greatest inequality in the world. Some of you could think about the fact that Brazil has had an experience with very high inflation rates. So indeed, we had a period of hyperinflation in the 80s. So inflation was above 100%, even achieved values above 200%. Yet, inflation is still a very relevant problem in the country. So after the adoption of the Brazilian real, we could control the inflation rates, and it reduced from those very high values to around 5%, let's say. So it's still quite high. 5% is not so easy to deal with, and quite often it reaches values such as 10%, which is what is happening now in European countries and in the US, and then it becomes a huge problem. And finally, a third stylized fact that some people might think of is the fact that Brazil has had and has very high real interest rates. So indeed, this is a ranking from 2022, in which Brazil appears as the country with the highest interest rates in the world, real interest rates. And it's quite often that Brazil is in this position or among the countries with the highest real interest rates. So what I want to do in this presentation is to connect these stylized facts to show that they can be related in non-trivial ways, and also to find a common explanation. So I'm not trying to say that this common explanation explains everything about the dynamics of these variables, but I'm saying that they can be related through this common explanation. And this common explanation would be the foreign sector. So more precisely, I mean the relationship between the domestic economy and the foreign sector that occurs through the nominal exchange rate and the foreign price levels in US dollars. So here, from now on, when I say foreign prices, I actually mean foreign prices in domestic currency, which combines, in a way, the nominal exchange rate and foreign prices in US dollars. And having such a strong link with the foreign sector makes Brazil, as well as other countries in the global south, have a type of inflationary dynamics, but overall an economic dynamics that is now relevant to the global north as well. So I think the type of the inflation that we have experienced in a structural way is what somehow resembles what is being experienced now by Europe and the US, and here's where I think the insights can be useful for thinking the reality of the global north as well. And what is important in this case is that when we have this type of dynamics, the relationship between inflation and income distribution will become ambiguous. To understand why, we need a little bit of theory, and luckily we already had that theory yesterday with Mark and Hein, so I will be a bit quicker with that. But I'm also here departing from Kaleckian work, and I think Hein's presentation was very clear in saying that what really matters is what triggers the inflationary process, because then the relationship with inflation would change. So if we are talking about cost-determined prices, we could have profit inflation, and in this case, we would tend to observe a reduction in real wages as well as a reduction in the wage share. If we were talking about imported inflation, which could occur because of imported inputs, material inputs, or also because of imported finished goods, we would also observe a reduction in the real wage and a reduction in the wage share. And kind of an exception, if we observe wage inflation, under certain conditions, we would observe an increase in real wages and also an increase in the wage share. So this is a different distributive effect from the other two causes. Well, Kaleckian also had some discussion on demand-determined prices. And I think for the case of Brazil, this is quite relevant. So inflation in these prices occurs when there is a demand and supply mismatch. And it will have a very direct effect on income distribution in raw material sectors. This is what Mark mentioned yesterday. So when commodity prices increase, it is an increase in the revenue of commodity exporters that has nothing to do with wages or costs. So this just becomes extra profits for them and therefore increases the profit share in that specific sector. This is also very much related to the price of commodities that are negotiated in international markets. So it is a source of imported inflation, but not because the goods are being imported, but it's as if the prices are being imported. And then we have it triggers an inflationary process in the domestic economy. And also in this case, we would tend to observe lower real wages and a lower wage share as well. So if we were to summarize these theoretical relations, we could say that inflation may be associated with a higher wage share and higher real wages if it is driven by nominal wage growth. Yet, and this process could be triggered by, for instance, a decrease in the unemployment rate. So it could be related to the dynamics that is captured by the Phillips curve. Yet, this is just one of the possible causes of inflation, and if we recall all the other causes that I've mentioned, we would tend to observe an inflationary process which is associated to a reduction in the wage share and in real wages as well. So if we want to understand what is the relation between inflation and income distribution in a given country, we need to understand what explains this inflationary process in that specific country, which is what I will try to do for the Brazilian economy. So this is the data that I will be focusing on. It goes from 2000 to 2020, basically because of data availability. I divided it into 3 sub-periods. So the first one goes from 2000 to 2006. It was a period of very high inflation rates, also very high unemployment rates. The profit share was also very high, so the profit share is the third graph there, I think you can see, right? And then there was also some increase in foreign prices, which was probably the main cause for the inflation that we observed, which was also very volatile. Then we have the second sub-period, which goes from 2007 to 2014. This was a period in which the inflation rate decreased, it became less volatile. It was also a period of reduction in the unemployment rate, and a strong reduction in the profit share. And here I should mention that this reduction in the profit share was also related to policies that were put in place to change the income distribution directly. So it can be related to unemployment, but not only. And then it was a period of some stability in foreign prices until they started to increase around 2011. The third sub-period is a period in which inflation reduces even more, but this time this occurs together with a strong increase in the unemployment rate and also a strong increase in the profit share, almost reversing the gains that we had in the previous sub-period. And there is a strong growth of foreign prices also in this case. So in order to understand and explain the co-movements between these variables, I will start by investigating the inflation dynamics and then go to the income distribution dynamics. And in order to explore the inflation dynamics, here I'm going to focus on the non-monitored goods, basically because I think it's easier to fit this theoretical approach into the non-monitored goods. But I will also split these goods into tradables and non-tradable goods because there are different exposures to international competitions. In competition mean that they will have very different dynamics, so we need to analyze them separately. So a good starting point would be to question whether there is a Phillips curve in Brazil. And here's the data for this global inflation rate for non-monitored goods. We see that it's almost flat, so there isn't really a Phillips curve there. And the same applies for inflation in the tradable goods sector. Yet, when we look at the non-tradable goods sector, there does emerge a kind of a Phillips curve. So we do see a significant and negative relationship between unemployment and inflation in the non-tradable goods sector. So basically what this is telling us is that, well, unemployment could be part of the explanation for inflation in Brazil, but it's clearly insufficient because when we look at the 2 other inflation rates, they don't seem to be so strongly related to the unemployment rate. So there's something missing in this explanation, and my argument would be that what is missing is the growth rate of foreign prices in domestic currency. So here we do see that there is a positive relationship which could be explained by imported inputs, imported final products, some effect of foreign prices on firms' markup if they find themselves being more competitive, and also as this effect on commodity prices, so imported prices, let's say. So we find this effect as significant for the non-monetary goods, also for the tradable goods. So this is the sector explaining this relationship. And it is there for the non-tradable goods. It's not significant in this case, but maybe this positive relationship is being explained by some wage indexation. Okay, so what we have seen here so far is that inflation in Brazil is a multidimensional phenomenon. It could be related to the dynamics of the unemployment rate, and in this case it would be mainly through the tradable goods sector, the non-tradable goods sector, sorry. But it could also be related to the foreign sector through the tradable goods sector. So here we have this first link between those stylized facts that I mentioned and the foreign sector, which is the importance of the foreign sector to inflation in the tradable goods sector and therefore inflation overall in the economy. Well, if inflation is a multidimensional phenomenon, we should expect income distribution to also be a multidimensional phenomenon. And if we recall this Kaleckian literature, we would expect higher unemployment rates being associated with higher profit shares. And here I'm kind of ignoring the fact that we may have overhead labor, but I'm emphasizing, sorry, Mark, but I'm emphasizing more the fact that when there's a reduction in unemployment rates, the bargaining power of workers increase, and then this might pressure downward profit margins. So this is the effect that I'm capturing. And we would also expect to see higher level of foreign prices being associated with higher profit shares due to the facts that I mentioned, such as the effect on commodity exporters' revenues and so on. When we look at the data, however, this is not exactly what we see. So this surface was obtained using the data from Brazil. We can see that there is a positive relationship between the profit share and the unemployment rate. So our first theoretical idea is verified. But then we see a negative relationship between foreign prices and the profit share, which is kind of at odds with our theoretical approach. But when we look at the subperiods, we see that the data fits our theoretical approach. In the first and in the last subperiods, it's only in the subperiod in the middle from 2007 to 2014 that we see this negative relation between foreign prices and profit share. So for now, I will treat this as kind of an exception, and I will explain why we have this relationship just in a little bit. So what is important here is that we have the second link between those stylized facts and the foreign sector, which is the fact that the foreign sector is important for income distribution in Brazil. But of course, the relationship between these two magnitudes, these two variables can change through time, and this is what these graphs are showing us. So, just a second, sorry. So we have seen a little bit about what determines inflation in Brazil and also what determines income distribution. So my idea here is to connect in theoretical terms what could explain the nexus between inflation and income distribution in Brazil. And the argument that I put forward in the paper is that this relationship could be described by what in a paper co-authored with Laura Carvalho and Lilian N would have called the inequality augmented Phillips curve. Nevertheless, the fact that inflation in Brazil is a multidimensional phenomenon creates a time-varying inequality augmented Phillips curve, and this idea will be clearer in a bit. So, if we have the case of wage inflation, for instance, we would probably be navigating along a stable inequality augmented Phillips curve, meaning that when we have, for instance, a reduction in the unemployment rate, this would lead to an increase in inflation, but would also lead to a reduction in the profit share. So we would see some effect on inflation, but also a redistributive effect. And this would be the case, for instance, when we have inflation related to nominal wage growth, as I mentioned. Yet this only explains part of the inflation dynamics in Brazil, and we would have to consider also what happens when we have inflation associated with imported inflation, for instance, or the foreign sector. So in this case, what we would be seeing is that, for instance, taking the T0 as a period in which there is no inflation associated with the foreign sector, and then having an increase in the growth rate of foreign prices, we would first shift up this inequality augmented Phillips curve, meaning that for the same unemployment rate, we would be observing higher inflation rates. So this is not being explained by a movement along this curve, but by a shift of this curve. At the same time, we would observe an increase in the profit share, and as long as foreign prices are increasing, the profit share would increase. That's why we would have a moving curve across time. So in this case, we wouldn't have a change in distribution and inflation that is explained by labor market. Nevertheless, the labor market and the unemployment rate is important for identifying where in these curves we are. So unemployment is still important for explaining inflation and distribution, but it's just that it's insufficient, and we need to consider the fact that this curve may be shifting with time. So in a way, I think that these theoretical ideas are very helpful for understanding what happened in the Brazilian economy in those three subperiods that I've mentioned. So the first subperiod was a period of very high inflation rates that were predominantly associated with high growth of foreign prices in domestic currency. At the same time, there was a very high unemployment rate, which helped to sustain this high profit share and growing profit share. So in that theoretical idea that I presented, is that it is as if we were moving along, we had moving inequality augmented Phillips curves to time, which would be explaining both inflation and inequality in this case. Then in the second subperiod, it's a subperiod in which we had low unemployment rates, stability of foreign prices, and we did observe a negative association between inflation and the profit share. So in this case, we would have been moving along this stable inequality augmented Phillips curve, being able to combine a growth in prices, so an inflationary process, with income redistribution. And then we had this increase in foreign prices, which nevertheless, we observed a continuation of this process of decreasing profit share, which is the exception that I will go back in a little bit. And then in the third period, we observed increasing unemployment rates and very strong growth of foreign prices in domestic currency. Both of these factors helped to sustain a very high profit share, while inflation decreased mostly due to the effect of unemployment, but also due to the effect of some policies that I will mention in the end of the presentation. So in this case, we would be combining movements of the curve as well as combining different points of the same curve, because both we had the effect of foreign prices, but also of the unemployment rate. So except for the period from 2007 to 2014, this framework seems to be adequate to explain what has happened in the Brazilian economy. What emerges as an exception is the fact that when foreign prices increased, we didn't have a positive effect on the profit share as we would have expected. So I think there is a kind of a missing inequality puzzle here, which is why didn't the increase in the foreign prices benefit firms and increase the profit share? And in order to explain this, we need to go a little bit into this sectorial analysis of the Brazilian economy. So this is the profit share across the different sectors. There are many interesting things here. One of them is the fact that the dynamics across the sector differ really widely. So if we want to understand what is happening at the macro level, we need to understand what is happening with the sectors. The second interesting thing is that the profit share in the service sector is almost constant. So there is a significant pass-through of costs to prices in the service sector. And the third interesting thing here is that all the redistributive process that we observed when looking at the macro profit share was explained by the industry sector and also by some composition effect. So if we want to understand what happened with the macro profit share, we need to understand how the profit share within each sector related to those explanatory variables. And here's the data of the relationship between the profit share in each sector with the unemployment rate. So we see that it's only in the industry that increases in the unemployment rate lead to an increase in the profit share. And also, we see here on the right that it's only in the agricultural sector that an increase in foreign prices leads to an increase in the profit share, as we would expect from our theoretical approach. in the industry sector, we have this negative relationship between the foreign price and the profit share. So the explanation for this missing inequality puzzle would be related to the industry sector. And this is something that I've explored together with João Santoro in another paper, where we argue that this is related to the changing relationship between the industry and in the foreign sector in Brazil. So what has happened in this period is that first, we became increasingly dependent on imported inputs. And second, there was a reduction in the international competitiveness of the Brazilian firms. This is very much related to the emergence of China as a superpower in the industry. So when there was this increase in foreign prices in 2011, those firms faced higher costs because they import a lot of inputs, and at the same time, they could not pass on those cost increases to prices because they were very weak in competitive terms. So they had to reduce their profit margins. And this is what occurred. This explains the movements in the macro data, but what is interesting here is also to observe that this has intensified the distributive conflict in Brazil, because those profit margins were already under pressure due to nominal wage growth, and then they had to be further reduced due to the dynamics related to the foreign sector. So this leads us to this connection between the distributive conflict in Brazil and the foreign sector. And there's a way by which we can try to measure this relationship. So here we can start with the decomposition of the wage share and then isolate the real wage. And according to equation 1, we have the real wage being dependent on the wage share, labor productivity, and relative prices. Relative prices being the relationship between prices of production and prices of what is being consumed in the economy. And what explains the difference between them is exactly those foreign prices in domestic currency, is what is being imported with different prices that are related to the foreign sector. So when we have an increase in productivity or an increase in relative prices, this helps to increase real wages without requiring an increase in the wage share. Therefore, this means that there can be real wage growth without pressuring profit margins. Conversely, when we have adverse movements of relative prices or labor productivity, this intensifies the distributive conflict because real wages will only be able to grow if there is a reduction in profit margins. So this is the behavior of real wages in Brazil in this period. We can see that it grew quite significantly. And part of this growth was related to an increase in the wage share as we would expect. Nevertheless, it was also explained by an increase in labor productivity and by this increase in relative prices, which was related to an appreciated domestic currency in real terms. So what is important here is that around 2011 to 2014, labor productivity and relative prices started to move in an adverse manner. And this is part of the explanation for why real wages didn't increase anymore. But what I want to emphasize here is that this created this direct opposition between real wages and profit margins in Brazil. So this has kind of made the distributive conflict in Brazil much more explicit. And as we know from this Kaleckian approach, a more explicit distributive conflict or an intensified distributive conflict tends to lead to higher inflation rates. But we also, sorry, this was also Kalecki that I wanted to cite here, but we also know from Kalecki writings that this distributive conflict has important implications for political changes in the economy. And here is where I think it's important to mention how the distributive conflict is managed in Brazil. So when we think about managing the distributive conflict, I think quite often in the debate, there's a lot of emphasis on the inflation targeting regime, because it is indeed one of the ways by which we can manage the distributive conflict. Yet there are two specific characteristics of the IT regime which make it quite particular relative to other countries, especially in the global north. So the first one is that the central bank could never really forget about exchange rates. It still intervenes quite a lot in the exchange market, maybe not as much as other countries, but there is some degree of intervention. And also the main transmission mechanism of monetary policy in Brazil is the exchange rate. So I could cite a lot of people here, but there's a lot of evidence that this is the main transmission mechanism. So here we have this third connection between those stylized facts and the foreign sector, which is that we need high real interest rates in order to the IT regime work in Brazil, either to compensate foreign shocks, but also to compensate domestic shocks by appreciating the domestic currency. This works as long as the interest rate, when it increases, leads to attraction of foreign capital and therefore appreciates the domestic currency. Yet, this is not really guaranteed because the exchange rate dynamics is much more attached to the global liquidity cycle than to domestic determinants. Nevertheless, if this condition is there, we would still observe that the distributive effect of higher real interest rates is kind of ambiguous. Well, of course, an increase in the interest rate represents an income flow to asset owners, so it's kind of benefiting the financial system. But if the exchange rate is the only transmission mechanism, we would also see an appreciation of the domestic currency, which could be related to higher real wages and also a higher wage share. So this means that the IT regime is insufficient to manage the distributive conflict in Brazil in the direction that is desired by the elites. And here there's an S in elites because there can be some disagreement between the financial sector and other elites. But it's not only insufficient, but it can also go in the opposite direction relative to what some elites would have wanted. So this is why in this context of a more strengthened distributive conflict around 2014 and 2015, more efficient and direct measures were required, kind of reverting a process that had been beneficial in terms of supporting a redistributive process in Brazil. So one of these measures was fiscal austerity, increasing the unemployment rate, and the other measure was labor market flexibility, reducing workers' bargaining power in a structural way. As a result, we had inflation being controlled, but more importantly, there was an increase in the profit share, and this kind of solved this distributive conflict in a way that favored the elites. So this was the context when the pandemic hit the Brazilian economy. In 2020, we saw again an increase in the profit share, which seems different from what occurred in other countries, but nevertheless is related to some specific factors about the Brazilian economy. And inflation stayed at the target in 2020, but there was also significant inflation inequality. So even though inflation was controlled, it was hurting more the poor, and this led to a huge debate in Brazil. We did have this strong inflationary process afterwards, so in 2021 and 2022. And in terms of the policies that were put in place, of course, monetary policy was still active there, but we also had this reduction in taxes on fuel in order to reduce the effect on real wages. I think, nevertheless, that even though this helps to maintain real wages, the distributive effect is still unclear because it could be benefiting the firms that are selling fuel. So I think here the effect is not still very clear. What has happened more recently, though, which I think is very significant and possibly positive, has been a change in the pricing rule from Petrobras, which tries to reduce the pass-through from foreign prices to domestic prices. So I think here is a policy that can help to control the inflation rate in Brazil, but also can have very positive effects in terms of income distribution. So to conclude, I think there are two questions that this discussion about Brazil can raise. The first one is a more philosophical question that applies to many countries, which is how can we deal with multidimensional inflation rates? So a lot of the debate now is exactly about this, and many people have argued that we could use different tools. And I would agree with that, but I would still question whether the right answer that we should have different degrees of tolerance to different inflation rates. So whether we should really cue an inflationary process that is related to a positive redistributive process is one thing, and then whether we would want to cue an inflation process that is actually concentrating income distribution is a very different thing. So it's really hard to find a solution for this problem, but I think it's something that we will have to question ourselves as we have this inflation related to climate change and so on. And, there's a problem here. But the second conclusion, which is more related to the Brazilian economy, is that the foreign sector has a very strong effect on the intensity of the distributive conflict in Brazil. And one of the challenges for the Brazilian economy, which I think we will have to do at some point, is how to reduce how much we depend on an appreciated domestic currency. First, because it is a tool to control the distributive conflict and control inflation rates, but I think more importantly, because it is a tool that allows for the adoption of redistributive policies. So it was only when the exchange rate was appreciated that we could implement policies that were good in terms of redistributing income. And when the exchange rate depreciated, we have had the reversal of those policies. So in a way, we cannot have our income distribution so dependent on something that is actually being determined by the dynamics of other countries, which affect our nominal exchange rate and, of course, affect foreign prices. So I think that's it. Thank you very much.